So, taking all political factors aside, why would taking your lump sum in one go, or in much larger chunks, be a good idea? Well, as with any financial decision, we're all different, and we all have unique circumstances. There is no universal right way of doing things, and a lot will depend on your personal motivations and priorities. Reason number one for taking a lump sum is usually to pay off debt, like a mortgage. But this still does require careful consideration. Let's say you have an outstanding mortgage of £100,000 with an interest rate of 4.5% on it. That would mean you're paying £4,500 to the lender. And assuming you had a tax-free lump sum pot of £100,000, paying the debt off would give you a guaranteed saving of £4,500 a year. Now, we know, of course, that your pension could grow by more than this, but that's not guaranteed. And we must also remember that if you were to continue paying the mortgage in instalments, you'll require income to meet that £4,500 expense, which means you'll probably need to pay tax first. If you're in the basic rate tax band for earnings, you'd need to be paid £5,625 to make those repayments. And if you were in the higher rate band, you'd require £7,500 of gross earnings. So a higher rate taxpayer who saves £7,500 a year is getting a guaranteed return of 7.5% on their £100,000 lump sum. But this does all need to be balanced against the fact that you are likely to pay higher taxes in future by taking more lump sum at the start rather than spreading that tax-free payment out. Instead of guessing at this, though, it may be best to take advice or run the numbers yourself by using cash flow modelling software. Don't just assume one way is better. Taking all the financial aspects aside, though, the emotional value of being debt-free can't be underestimated. Some things have other value rather than just monetary savings. I've heard many things said in my 20 years as a financial advisor, but I've never heard anyone say, "Oh gosh, I really regret paying off my mortgage." So reason number two to take your lump sum might be to gift money, maybe to children or even to charity. Again, you may see more value in doing that than monetary gains for yourself. If you have other sources of capital, though, it still makes sense to work out the best way of achieving your aim for your own benefit as well. I had one client who had £50,000 in premium bonds, but wanted to use his pension tax-free cash to make some gifts. Logically, he'd have been far better doing it the other way around. And this may even be the case if you have other investments that you'd pay tax on to access. So before you make a big gift, check which pot of money will leave you better off in the long run. And the third reason for accessing larger sums of tax-free cash might be personal factors, like health. If you feel you have a shorter life expectancy and you want more money now to make the most of precious time, obviously that's a very valid reason. So your own circumstances will be what ultimately matters. But looking at this through a pure tax planning lens, there's one specific objective where a full tax-free lump sum withdrawal is going to give you a better result. So reason number 4 is for other tax reasons, rather than just your own income tax position. Changes announced in the last budget mean that pensions will be subject to inheritance tax from April 2027. And this will affect a lot of people. I have one client who will go from paying no tax at all on his estate to suddenly being faced with a £1 million liability, just because his portfolio is so pension heavy. Currently, a married couple with children will often have a joint allowance of £1 million to protect them from IHT on second death, which is when the tax becomes due. And pensions have traditionally not been counted towards that £1 million. But from the 6th of April 2027, they will. And because your pension lump sum gives you access to a large amount of money that can be taken out of your taxable estate in various ways, it can make sense to do this. I helped a client recently who wanted to do something about his IHT problem, but he didn't want to lose the benefit of the tax-free cash for himself either, because he'd worked hard for it. So by taking his full lump sum and using something called a loan trust, which effectively provides a way to move money out of your estate gradually without losing access to it, he was still able to take a tax-efficient income and save his family over £80,000 in projected IHT in the process. Now, this scenario may not be relevant to everybody, so I won't go into the full detail here, but I have written a piece that breaks it down comprehensively if it is of interest to you, and you can find a link to that in the description below. Now, there is potentially a reason number 5, which many of you have asked me about recently, and that relates to taking your tax-free lump sum and investing it elsewhere once you've hit the maximum lump sum allowance of $268,000. Pensions expert Tom McPhail, who, funnily enough, used to work up the road from me in Wolverhampton, wrote about this recently because he's decided to do just that. The primary reason being that all further growth on your pension, once you've hit that lump sum limit, will be subject to income tax on withdrawal, whereas other investments wouldn't be. It's not as clear-cut as it might sound, though, and I'll be giving my own thoughts on that in a separate piece where I do some analysis on the numbers. If you'd like to receive that, as well as other thought pieces from me and other members of my team, you can join our free mailing list, which I've linked below. We're all qualified and regulated financial advisors, and one of my partners also spent 25 years as an investment manager before joining me. So we have a lot of deep expertise right across the financial planning spectrum. If you didn't catch the first part of this little tax-free lump sum series, where I talk through the benefits of gradual lump sum withdrawal and also go into the power of using a spouse's pension allowances to full effect, it's on screen for you now and linked below. I'll see you there.